Well, hello there, my friends. Chris Mark is here with you for Arcadia Economics. Welcome on into the show. We have a midday matinee today where we are going to discuss whether there will be a failure on the COMEX this year. Fortunately, I am joined by two great COMEX experts, analysts, and certainly in an interesting time in the world, a lot to dig into. So, real quick to welcome our friends in here. Rafi Farber of the Endgame Investor. How are you today, sir?
I'm pretty good considering I'm on a complete lockdown, but things could be a lot worse.
Well, I guess that's fortunate for us because you have plenty of time to dig into the COMEX on a level that I think is really hard to find elsewhere. Maybe if there's one other source, at least in the galaxy, it would be our friend Rob Kientz of goldsilverpros.com. And also, Rob, I hear you have a conference this Thursday with not what's going wrong, but some actual solutions. Is that right?
That's right. We got a conference called Solutions 2021. It'll be this Thursday. So I guess 2 days from now. And I'll be hosting yourself as well as many other guest speakers, 11 a.m. to 9 p.m. Central Standard Time. It's free registration. And Chris, if you'll just include the link in the description.
Yeah, that link is in there. And Yara, perhaps you can put that in the chat so folks can get access to the conference. I'm looking forward to it. And one last note before we dig into all the wild things happening on the COMEX, but we do have a sponsor for today's show, which is Bluestone Resources. Jack Lundin, who you've seen on the show before, and is advancing their Cerro Blanco gold project. And here they were announcing that basically they did a project readiness update, thorough and extensive review of the current mine plan, engineering, flow sheet, capital, and operating costs, along with the execution strategy. And Rob, I know you're familiar with Bluestone. In fact, when I first heard about them, I asked you, you want to give a quick recap of the news they have here today?
Yeah, so this is basically their 2020 highlights. So they have opened a $30 million credit facility with Natixis, which allows them money for exploration and to kind of takes away the uncertainty around where they're going to get their financing, which is so key to the explorers. They got their financing secured. They can use as much or little as they needed that. Jack Lundin was appointed as a CEO into the board of directors, which is big because the Lundins are really, really big mining family, serially successful, get involved in a lot of good projects. And when somebody like that signs on to your company, you know you're doing very well. They did a lot of optimization. They did their studies, engineering assessments for their project, 92 million equity financing, of course, for the company. Completed basic engineering, but probably the part that investors really want to hear the most is they completed 15,000 meters of infill drilling. Infill drilling is a type of drilling that you do on a mine to tell exactly how good your resource is. So you start doing your dispersed drilling to see where the resource is. You infill to see, okay, how much resource do we actually have? And it's highlighted here by 1,380 grams of ton gold and 2,194 grams of ton silver at one of their intercepts, which is astounding. Those are bonanza grades, beyond bonanza grades on both fronts. So it's going to be a good gold, silver exploration company. And because of their success this year, it looks like their profile just got upgraded. So this definitely is one that your viewers may want to take a look at.
Well, appreciate that, Rob. Again, you can find out more at bluestoneresources.ca. And with that said, for the question of the day, and Rafi, let's start with you. We'll just throw it right out there. I mean, we've heard people talk about it for years. The events are seemingly building. You're one of the people writing about it. So do you think we're going to see some sort of break in the COMEX this year?
Well, when we say break in the COMEX, we're probably talking about something like the gold shorts are unable to deliver on the gold that they promised to deliver, or something like that. Right? But people conceptualize it as in like if the COMEX fails, then the dollar fails. But I see it the other way around. I mean, the question, will the COMEX fail, is more of a question, will the dollar fail? The reason I say that is that the only reason that a massive amount of futures traders or a massive amount of institutional investors would want to deliver on physical gold and actually have it is because the dollar is failing. That's why they would want monetary gold. So if we were going to get like a flood of physical demand like that and stands for delivery in in the hundreds of thousands until it clears out the COMEX, the dollar would have to already be significantly, obviously on its deathbed, like let's say inflation 10% a year or 15% a year, and then it becoming obvious that these debts can't be sustained anymore. So then everyone would go to the COMEX and say, yeah, give me the gold and take the dollars and let's just get out of here. So yeah, a dollar failure would probably cause a COMEX failure. But if the dollar is still functional in some way as a money, then I don't see it happening. So the question really is the dollar going to fail this year? And it could very well happen, especially if food prices start to rise very fast and the CPI finagling that they do is no longer believed.
Yeah, I think that's a great way of phrasing it. And Rob, what do you think about that?
So the COMEX acts as the futures market for most of the world. You have the LBMA, which is really sort of an OTC, unallocated gold market. So if you're wanting to trade futures, most people go to the COMEX to do that. And it's sort of the center of it. So it's not really a great physical delivery market. However, there have been healthy deliveries on it this year. In fact, I think we had more deliveries on COMEX this year than we've ever had. Rafi did a really good job in his Endgame Investor newsletter of talking about a particular phenomenon that started to occur a couple of months ago. And that was that people were using the COMEX for spot delivery, meaning in a futures market, you'll take a futures contract. If you want to actually take delivery of the gold, these sellers will say, okay, we have gold to deliver, and the longs will take that physical delivery. But that occurs a small percentage of the time. But typically that while the longs will declare their intent to take delivery on the month of delivery, the futures positions are set up ahead of time. What's been happening the last 4 or 5 months, Rafi, correct me if I'm wrong, people have been coming into the COMEX and been taking what he calls spot delivery, what other people have been calling the shadow contracts. And that's essentially they're coming into the market, they're presenting a futures position, they're taking delivery of that gold almost immediately within a few days, because it does take a couple of days on the COMEX to facilitate that transaction. So now you were getting, for several months, a lot of physical gold pulled off the COMEX, when traditionally it's heavily dominated by the paper trading, the paper side of the market. Then we started to notice at the end of 2020 and going into 2021 that had slowed down. December, we expect to be a really big delivery month, and it was fairly robust in gold and silver, but it had started to slow down in the precious metals. And then we saw the EFPs kick up. The EFP is an exchange for physical. It's where you take like a COMEX future position, you go over to like the London market and you do your physical that way. So some of the physical delivery that had started to occur on COMEX looks like it's been shifted over to London. So people are going back to London to get their physical gold. So there's all sorts of uncertainty and questions around, what happened there? Why did people go to COMEX to pull a lot of delivery, more than we have that I've seen in recent memory in a given year on a market, which is really a futures market. And then why all of a sudden did that stop and it started to shift back to London, to the LBMA? It's very curious. I think it shows maybe some signs of distress in the inventory numbers. One thing I talked about on my show, I want to say last night, and then also we've been talking on it the last few weeks especially, is there are ounces coming out of the registered category, which are the one tied to the actual deliveries, and going into eligible, which is basically just gold storage. So people are using the COMEX vaults for gold storage. They're not necessarily using it for delivery of the physical as much as they were in 2020. So we'll have to see that trend. Now, why I bring that up is because if the COMEX runs out of physical, while it is a futures market, it would affect their credibility to be able to deliver the metal. And if all you're doing is trading paper on this market, and it's just a bet on gold one way or the other, then it shouldn't really affect the gold price, and it shouldn't affect the gold market, I would advocate. So we'll have to see if those delivery patterns hold up in 2021 to see if they're really having stress in their physical inventories.
Well, Rob, we have, and Chris, we do have a big delivery date coming up on Friday. I think it starts. Mm-hmm. Right. The February contract is reaching its rollover deadline, I think on Friday, on the 29th. And then the remaining contracts in the February contracts that are open should go to delivery or otherwise settlement. So I think there's something like 125,000 left, and like 25,000 rolling over the last few days, for the last 3 days. So I mean, at this rate, there could be about 50,000 deliveries. I think that was the May or the June record last year. But I mean, it's hard to say how many of these deliveries are actually physical gold leaving the COMEX versus how much are just delivery tags or warrants being exchanged on gold bars inside that, and everything's kept inside. So the one thing I'd point out is that one thing that we haven't seen, and you were correct about the spot deliveries. The other thing that we're seeing is that the other reportables, again, those people that are trading their own accounts, they have a lot of capital and they'd be interested in getting physical gold delivered, as opposed to the money managers or the hedge funds that don't, because they're managing other people's money. They are still holding a record position of about 170,000 contracts, which is unprecedented, and it keeps inching up month after month after month. But if these people were taking delivery, we would see their positions start to fall as the contracts close out and they actually get their delivered gold, which hasn't happened yet. So, and in the meantime, the managed money category has fallen, I think, to the lowest level since May 2019, which was when gold finally broke out of its 6-year trading range. So I think we're seeing some very bullish numbers on the COTs, and I don't think the other reporters are going to be spooked out of their positions by the bullion banks smashing the gold price any given day. I don't think that's going to happen.
Well, Rafi, you raised the key question there. I know there's been a lot of debate, rightly so, but what can we take away from these COMEX numbers? We've seen the deliveries are large. Like you point out, it doesn't appear yet. I haven't been seeing much evidence of metal leaving the building. So perhaps, Rafi, you can start with you, but what can we take from that, and what does it really mean?
Well, I'm thinking, I've been pondering this question a lot, because nobody really knows what's going on behind those doors, and nobody's going to answer those. Nobody's going to answer that question straight. It's like trying to ask, the chair of the Federal Reserve to, say something honestly. It's just, he has his script and that's it. So, I mean, I'm thinking, if I was a COMEX trader, why would I stand for delivery and then not take the metal? Just exchange the warrants. Maybe some of it is leaving, but it seems that the supply of registered metal goes up and down, and there's no real crisis going on yet. It seems to me maybe it's the beginning of some suspicions. Maybe they want their warrants to, or they want the right to their bars. Maybe they have an intention to take it later, or, they don't want to be stuck standing for delivery when there really is a crisis. It could be just some kind of suspicion that maybe something is off here, which was pretty obvious in March and April when when the shutdowns first started, and then there was these huge premiums in the physical market. So I think it's just actors in the COMEX getting ready for, if they need this, they should already have the warrants in their names, and then they wouldn't be in a scramble. It's like let's call it like COMEX preppers. Maybe they're unsure and they're being careful.
And Rob, what do you think?
So the issue, I think, with the COMEX is I think they did run out of gold earlier this year, or get really close to it, because there was a huge amount. And I don't have the chart ready for you. I wish I had. I showed this earlier on in a video. I want to say about a month, 6 weeks ago. In 2020, they came dangerously close to having no registered gold stocks. I can share that if you don't mind. I'll share a screen on that.
In a moment.
I'll talk through that, Chris, as you allow screen sharing. But so essentially, they ran dangerously low on registered inventories of gold stocks, which means those are the ones that get delivered against the contracts. So let's look at this chart from Gold Charts R Us. You can see the eligible, which is the light green, had surpassed, after the last financial crisis, had surpassed registered. Registered, this dark green, as you can see, dwindles here from the financial crisis to about 2020. Had dwindled down to almost nothing. In fact, it had touched zero, I think, 3 times and almost a 4th time. That means that nobody's putting that gold up for delivery on futures contracts. And if you don't have gold for delivery on futures contracts, you don't have gold. Again, there are 2 categories on COMEX. There's registered and eligible. If you're sticking at eligible, it's just storage. And I think April 19th, this came out. Ronan Manley of Bullion Star was the first to document this. On April 19th, it came out that the COMEX admitted they had no clue as to how much of their eligible gold inventories could be up for delivery on a futures contract. They were guesstimating 50%, and they said, you know what, we'll move that up or down. We don't really have a clue. And the reason is because it's private investment. So the majority of the stock was right here. You can see right here, they had nearly no stock for the actual futures positions until this point. And this point occurred, I want to say, I think it's about April, if I remember correctly, I want to say around April 20th or so of last year, the registered category, this dark green, shot up, and all of a sudden there was this influx, and you can see the overall amount of gold just shoot up on the COMEX like all at once. It happened over a period of a few days. It's like they just took this massive delivery. And I don't have the next chart for you, but I have documented in my videos previous to this that most of that gold we think came from London, because in the last 5 years there have been very minuscule deliveries from London to the US. A little bit here and here, but net it had been negative. More gold had flowed, east to London than had flowed west to the US. That trend reversed in April at the exact same time that the COMEX inventories exploded. And there was a massive amount of gold that came from London to the COMEX. So what I think happened, more than likely happened, or at least a large part of what happened, is that the London gold market basically bailed out the COMEX, and that's where they got their gold from.
Could be. Two things about that, Rob. The date April 20th, that was probably one of the weirdest days in modern market history. I remember, I think that was the day that oil went to like negative $35 a barrel, and everything was just getting mixed up, and nobody knew what was going on. The other thing I wanted to mention is that I had looked at gold import statistics around that time, and you might be right about London, but I seem to remember that I think Switzerland was also involved. Maybe London didn't have enough, or maybe London was going through Switzerland or something like that. Maybe they owned gold through the Swiss, and a lot of it was going through JFK. Most of the gold imports in April, May, and June during that quarter went through the JFK airport, which is COMEX rules. I think it has to be within 100 miles of New York City. So all that gold coming from Switzerland, maybe someone from London, was going to the COMEX. So that was a huge import boom of gold in just a few months. So yeah, it might have been an emergency.
Yeah, and Rafi, in your recent article that I'll pull up here, you also mentioned that you see something building in Palladium, which gets a far less attention. So perhaps you could share what you're seeing there.
Well, Palladium, I'm not a Palladium expert, but I follow it along with gold and silver. They do tend to move together sometimes. So, I noticed in Palladium that, I'm looking at this chart since somewhere around July, it looks like. Since July, Palladium has moved within a very, very tight trading range. Something that I've never seen a coil this long. Usually when a security or a commodity coils like that, there's a very tight bid call spread. And I'm not talking about on a scale of a minute, but in a scale of weeks. Like if you reach a certain price, it's knocked down, then it gets tighter and tighter, which means there's a big fight going on in the price. And I can't figure out exactly what is special about Palladium that is giving it a 27-week long coil like this. But usually when they break, they first break to one side and then they break to the other side. Usually when a coil breaks, you see it go down, sharply for a week or two and then reverse, or sometimes it goes up sharply and then reverses down. But what I think is a lot more interesting than Palladium and is related to this coil could be platinum. Because platinum, I think for the first time in 21 years, first time in over 2 decades, excluding the 2008 crash, I think we have a platinum golden cross, or you could just call it a platinum cross, where the 50-day moving average, the 50-week moving average moves above the 200-week moving average, and this is the first time that's happened in 21 years in platinum, and platinum has been severely underpriced for a very long time. So I think the coil in Palladium and the price action in platinum might be related. So they're both platinum group metals, and they're used for similar industrial purposes.
Yeah, will certainly be interesting, especially platinum. I believe the all-time high was 2,300-ish a week or two before Bear Stearns collapsed. JP Morgan took over, and the price price plummeted, which I'm sure is just a complete coincidence. But Rob, amongst other things that I'm sure mean absolutely nothing and people would be wise to throw in the conspiracy theory bucket, what do you make of this massive one-day addition to SLV and the Silver Trust? It looks like it was about 20 million ounces. Now, keep in mind, this is the weekly chart, but if you look at the one-day chart, that was the biggest one-day addition going back 2 years, 5 years. I think if we go back 10 years, we can find one day that was bigger than that. But any thoughts on what we saw last week on that one?
Yeah, so the way that's supposed to work, and if you go back to my conversation with Nick Barishev, who's president and CEO of BMG Group in Canada, runs a gold fund, and has read the authorized participant agreements for SLV and GLD. He thinks, based upon his reading of that and his understanding of the market, being a gold fund CEO, is that a lot of the gold and silver that go into the GLD and SLV are leased and they're not owned because their fees won't support them purchasing and holding that. So you can have a big influx of silver into SLV, and that may reflect some of the transactions that people, purchasing shares of the SLV, whether or not they actually have that silver or the GLD has that gold. We don't really know because there's chain of title issues, and that's endemic in the gold industry. There's no way to tell that someone holds a bar that someone else doesn't have a claim to it, really, unless you audit it end to end every holding facility and put all that together. And we know that doesn't happen. So when I see something like that, it indicates there's a lot of demand for silver. But what I really want to know is who really owns that silver. Where did it come from? So those are my questions.
Well, I think that's fair enough. And Rafi, you looked like you had something to say there, perhaps? Comment on that?
I was just recalling again what happened on April 20th with oil. When oil went to like negative $35 a barrel, and then you had this U.S. oil ETF, USO. Something happened. It stopped tracking oil. It just totally backfired. And if we can see oil go to negative $35 a barrel, and in that time, gold was also selling off, but much less than any other commodity. Gold and silver were even though they were crashing, they were much stronger than let's say oil or wheat or any of those agricultural commodities on that day. If we can see that, then we can definitely see ETFs like GLD and SLV go the other way. If physical demand for gold on a failing dollar becomes a serious issue, these ETFs are not going to help. They'll help track price, and if you want to play options or leverage to get more dollars in the meantime, they'll work for a while. But like when there's a real crisis, they're not going to do much.
Yeah, I think that makes a lot of sense. And again, you guys both talked earlier about maybe the metals happens when there's an overt fracture in the dollar. Gee, sure seems like these guys are trying their best to facilitate that. Because let's say 10 years ago, if we go back to 2011, let's say that I told you that a former Federal Reserve chairwoman was now running the Treasury, Fed balance sheet bigger than ever. God only knows what they have planned this year. But to the degree that now a former Fed chairwoman actually says this.
But right now, with interest rates at historic lows, the smartest thing we can do is act big. In the long run, I believe the benefits will far outweigh the costs, especially if we care about helping people.
Well, first of all, I'd like to applaud that eloquently placed demagogue at the end. So if you don't act big and destroy the currency and steal money from the middle class that's working, you're the bad guy. Leaving that aside, isn't this the same thing Bernanke said back in 2010? We were supposed to act big then. They've been acting bigger and bigger. They set a new record for biggest act ever last year. And now, whether there's independence, not independence, now you have Powell who's already acting big, and now the Treasury is talking about acting bigger. So, I mean, is it possible that we will see that overt Lehman-like fracture of the dollar this year? Rob, you want to take that one first?
I don't think we'll see it this year, and there's a couple of reasons why. So really quickly to address what Ms. Yellen said, she's talking about mono-monetary theory. And that's, if you've looked at the amount of money supply in M0 and M1, it's basically gone hockey stick. So when you see hockey stick formation or vertical formation in monetary creation, in the past, that's always led to the death of currency. So I could see people saying, yeah, we're getting closer to that stage. However, what happened in 2020 were a bunch of shutdowns, not only in the US, but around the world. So a lot of the flow of currency, the velocity of currencies had slowed down. And I think that temporary deflation had basically saved the monetary system or extended it out just a little bit. I don't think it saved it long term, but I think it gave it more time. And I think they've already got their replacement system ready. They want to go to digital currencies. They've trademarked the digital euro. The Fed has put together FedNow, which is direct payments to people, digital format. So and the IMF has laid out this plan in 2015. I've documented this on my channel. And the BIS has concurred with this. So all these supranational groups and the central banks have all come out and said, we want to go digital. They're not ready to quite go digital yet. Their frameworks aren't completely in place. There are some issues with the current digital currencies. They've got to get those worked out. They cannot let the fiat currencies die yet. They can't let them. They're going to put them on life support as long as they can until they're ready to flip the switch. When they're ready to flip that switch, they'll let the currencies completely die. Working against that, of course, is the internet and people, social media, deciding that, hey, that's one thing. Hey, we believe that the currencies are weak, and I won't limit it to the dollar. I say the dollar, the euro, the pound, even the Chinese yuan will come under some pressure as well. All of them will. And so the people are going to start looking for alternatives. And I believe in terms specifically of the dollar, you've had all these other countries getting out of dollar denominated trade and dumping treasuries and things. So they're exiting out, but it's a fragile balance. You don't want to exit out too quick and crash it, because if China exits out of the dollar and dollar trade too quickly, they've got all those treasuries, and they don't want that to blow up in their face. So it's like people are tiptoeing around the fact that they know the dollar is going to die, while you have the Western central banks trying to keep the dollar alive just long enough to get the digital currencies out there. And it's literally a tightrope. And I don't know if they're going to be able to hold it together until they roll out the digital dollar and the digital euro and the digital yuan. I know China's leading the way in terms of digital currency. Europe is right behind, and the US is right behind. But they're trying to keep it alive. I think for an individual perspective, your hedge is gold and silver, because if something like Rafi said earlier, if the dollar dies, if we have a banking crisis, a black swan, and it ends up killing the system, and they don't have the digital currencies ready, it's going to be pandemonium. And that's where you're going to want to have your gold and silver, because that's your value. That's where you're going to survive that sort of situation.
Rafi, if I can give you just the same question, slightly different twist, is Janet Yellen, the Fed, whoever else is involved in these things, are they going to go big enough to push silver past $50 this year?
I don't I don't know on specific price targets, but yeah, it's very possible. One thing I want to say about Janet Yellen and these people that are high up and they have a lot of power and a lot of money printing tools at their disposal. We tend to think that they have these grand plans and they know what they're doing. And this is where I part company from Rob a little bit. I see things a little bit differently. That I remember something Julian Assange said in an interview maybe 3 or 4 years ago. And he was asked something along the lines of, what's the scariest thing that you noticed in seeing all these cables and seeing all these state secrets? And what he said was like, what scared him most was that there was no organized plan to any of it. It was just a cacophonous mess of power centers that are squabbling with one another. And the right hand doesn't know what the left hand is doing. And it's just this massive bureaucratic power machine that's totally confused with itself. So I don't think there's any central plan, or if there is, there's several of them from different power centers. But I don't think any of them really know what they're doing. And I think they've drunk their own Kool-Aid so deeply that they might think that they are absolutely powerful when they're not. But something is going to slip. And I think it could be this year. And I think the focus should be on food prices, because Rob mentioned something about a velocity of circulation, right? But people need to eat. They need to eat the same amount of food they ate when they're not under lockdown. So that means that all the demand for stuff that they're not buying, all the demand that for food, for let's say airline tickets, which they can't buy anymore, is going to go into stuff that they can buy, which is food, or they need to buy because they need to buy the same amount of food, whether they're eating at a restaurant or at home, doesn't matter. And when prices of food become obviously higher, and people see what's happening to their grocery bills, forget about the CPI. How much is it costing me to go buy food for my family for a week? I mean, they can see the numbers. They don't need the CPI to tell them this. And when it goes too high too fast, they're going to keep buying and hoarding. They're going to hoard, and they're not going to want the dollars anymore. And that's when you're going to have hyperinflation. And digital currencies are just going to make it worse, because the only thing that slowed down hyperinflation in Weimar Germany was the physical constraint on actually printing the paper money, which if it's digital currency, it's going to go even faster down the drain.
Yeah, it's like
I will disagree with that for one moment, because I think the digital currencies, now I'm not going to say the digital currencies are going to be successful. I know I've disagreed with people like Alistair McLeod on this, and he's made comments on my channel. He disagrees with this, and that's fine if he does. I believe that the cryptocurrencies left alone in the current debt system would behave exactly as Rafi said. They would die faster than the printed currency. But the problem is they're not going to implement those in the current system. That's why they're not ready to implement it yet. When you tie together negative interest rate policy, you tie together modern monetary theory, which is basically print to oblivion, and then you tie together the digital currencies. What they're going to do is they're going to negatively discount the value of your digital currency in the bank. So if we go back to whether or not there's a global plan, if you go back to the position paper released by the IMF that's still on their website in 2015, which I've written about several times, they outline a plan they think they're going to implement. Whether they're successful or not, this is their plan. When they roll out the digital currencies and try to push out cash, they're going to discount your bank account electronic dollars by a certain amount. That's negative interest rates, not in the bonds, but in the banking system. And they think that's going to allow them to control the currency in circulation. Of course, the other tool that they have is taxation as well. And that is a popular Keynesian trope, which you can take money out of circulation by taxing it. You can also discount it through people's bank accounts. Whether that system works or not is to be seen, because they've never done it before. But that is their stated plan. And it is fully outlined in about a 50-page paper in the IMF as to whether they can all implement this, because you do have different regimes. You do have different central banks. Of course, the commercial banks are involved in this as well, because they're the ones that get the money first. You know, I do think that they're squabbling over it, but I think that the world is sort of moving that direction. China has indicated they're moving that direction. The European Central Bank has indicated they're moving that direction. The US has indicated they're moving that direction. How they facilitate that, you know, that will determine how much chaos we have and whether or not this system will stick. I don't think it's going to last forever, but I think they're going to get something into place where they go those digital currencies and they try to manage it. Now, as to how well they manage it, I don't know, but that again goes back to why you want to have gold and silver. That's your backup plan, because I do think whatever happens in the fiat and the digital currencies, it's going to be very chaotic and not as smooth, you know, as we've been used to. I would say prior to the last financial crisis, leading up to 2008, it was relatively, you know, a good system with some issues here and there. As we accelerate to the end here, it's getting more chaotic. And I think when they switch over to the digital currencies, it'll get even more chaotic. And that's why I think you want to have the gold and the silver. And I'm going to keep saying that over and over. The gold and the silver is your shield, it's your protection.
Well, on that, we definitely agree.
Yeah, and I think one of the themes that you both touched on and are in agreement on that I've been thinking about a lot, where, you know, yeah, things are manipulated. Yeah, there's a lot planned in advance, but I see it more, it's like a tie game in the fourth quarter. Nobody knows how this is going to go. I don't think the story is written, which kind of makes it fun when you can actually, you know, get in there, and maybe that's what life is all about. Fellas, we have 9 minutes left, and I have a couple reader questions. So maybe we'll do a lightning round here. If we can, we'll just one person per question. If you can keep it 30 seconds or less. And also anybody watching in the chat right now, type in your questions and we'll see how many we get to. But Rob, I will toss the first one to you here again, and keep 30 seconds or less. To what extent do the manipulators have the ability to keep manipulating indefinitely?
They can try to manipulate indefinitely. Their manipulation tactics tend to work in the short run. They got to keep doing it over and over. There's a research paper I quoted months ago, written by somebody who had looked at the U.S. commodities markets for about 130 years. and I guess coined the term hammering. You hammer the markets and it keeps it down, but it comes back up. So the market will eventually overwhelm the manipulators. But in the short run, the manipulators have the advantage because they have the market data and they have the tools. So what you want to do is be long-term and outlast the manipulators.
Can I take a crack at that one?
Yeah, actually, I'll toss in a little bit. Question number 2 is similar. If the banks have unlimited funds to buy COMEX contracts and sell at will, why would they ever stop? So take it away, sir.
Yeah. Well, so when we're talking about gold manipulation, let's take it from another direction. I mean, if we were on a full gold standard, the price of gold right now, according to in accordance with the money supply, would be something like between $18,000 and $20,000 per ounce. So the fact that it's only $18.50 or whatever it is today, that's the big manipulation, and that's because there's very little demand for gold, physical gold, as a monetary medium, except maybe for the hoarders who plan to use it as a monetary medium when the dollar collapses, and central banks who, to some degree, in some countries, back some of their money supply. So when we're trying to blame the COMEX for manipulation, it's small change compared to that big manipulation. And what's the limit? The limit is the absolute limit is the demand for gold as jewelry, which is the second biggest demand for gold. It's not monetary, it's jewelry. So if, let's say, the COMEX, let's take an extreme example, manipulated the price of gold to $100 an ounce, then you'd have all these jewelers buying as many contracts as they could and taking delivery on them, and then that would be, that they'd arbitrage it back to around where it is now. So it's really the monetary value of gold that's being suppressed, not the industrial or the jewelry use. And that's the absolute limit, and it will break.
All righty, we're going to take one from the chat here. Joey from Seattle. Rob, maybe you could field this one. Why aren't U.S. Marshals arresting the bankers?
Well, that's a good question. I've asked this for a lot of people who have been in the industry for a very, very long time, both in gold and also the financial industry. And there are a lot of laws that make a lot of what they do legal, not necessarily the spoofing aspect that people are getting fined for, but a lot of the malfeasance that occurred in 2000, 2009 was legalized. Is it lawful from a constitutional sense? No, certainly not when the government's involved. But from a statutory sense, when they make laws that allow them to do things. I'll give you an example. FASB 56 is an accounting rule that was passed by the Financial Accounting Standards Board, I believe, which allows the government to go dark. They can report whatever number they want on their financial statements, and it does not have to be true in aggregate or each individual transaction. So there's now 2 books from the government. There's the transparent books that they don't show you, or the books that are real, and then there's the books that they're going to give you. So they can spend any money amount they want. Of course, Dr. Mark Skidmore from Michigan State University, Catherine Austin Fitts, former Assistant Secretary of HUD, documented what was 21 trillion in missing money is now 50 trillion. And now we don't even know what the next number is going to be because they went dark with FASB 56. Those are legal constructs which allow them to do it. Now, are those a violation of the Constitution and the requirement that the government is transparent with their finances? Yes, but until somebody takes that to the Supreme Court, it is what it is. And so you're not going to get that transparency in the spend, and they're not going to go to jail because they have a piece of paper that says that they can do that.
All righty. Number 3 on the list here of 4. Why are gold and silver markets on COMEX allowed to trade what seems to be 100 paper ounces for every actual ounce when other commodities are traded at a much smaller ratio? I'll take a quick comment on that. I don't think it's that the other ones aren't allowed to. And when I've looked at this, most commodities seems to be the same thing, just to varying extents. Rafi, do you have a quick comment on that one?
Well, I would say that banking cartels have a vested interest in keeping the gold and silver price down, because if it goes too high, their money is sick. But they're not going to. Farmers are going to be the ones that are trading wheat and oat futures, and they're going to be trying to hedge their bets. So the banks aren't going to try to manipulate that so much with their money, but gold and silver they will, because that's their business. Whether they know that consciously or not, I'm not sure, but I think they realize it, and which is why they're in there and they're dumping contracts. But even so, it's really small change compared to the real manipulation, which is gold should be $20,000 an ounce if you're on a gold standard. That's the big issue.
Well, it'll be wild to see whenever this stuff finally does lose their grasp of control, what numbers we get. My gut tells me they'll be bigger than I think. But anyway, we'll leave that there. And in the chat room, I don't know if you guys are watching this, but apparently Bob Hunter is on fire. So, Bob, for you, I will ask Rob, what do you call a sheep that is religious?
Don't have a clue.
A Baptist, says Bob Hunter. So thank you, Bob, for lightening it up for anyone who's not feeling the silver price today. Although we'll do one last serious one before we wrap up here. Perfect question. What do you think will be the trigger when the banks, BIS, finally stop the manipulation? Will this be their choice, or will they be forced by a change in market conditions outside of their control? If the latter, what would that be? I'll go first on that one. I think they'll eventually just lose control. You guys touched on it before, where you got to remember, it's like the banker, it's kind of like that CIA gangster goon mafia mindset, but like when things go bad and they start turning on each other, and you're not dealing with people who are looking out for each other's interests. So I think the greed ultimately implodes upon itself. And one day you have a break when someone shows up for metal that they can't deliver. But quick thoughts on that one, Rafi?
I think it's food prices. It goes back to that, because once people can't eat enough food, what's financing all these lockdowns and why aren't people rioting in the streets is because you keep giving them checks and they can still buy food with it. But at some point that's going to stop, and people aren't going to have enough food, and they're going to get angry. And that's when this whole system falls apart. You need to give the masses their bread and their circuses. Right now we have, their dollars and their Netflix. That's what keeps everyone calm. But that's not going to last forever. And when people get angry, they will go out to the streets, and the entire system will be under basic threat, and they'll be forced to back the money, because otherwise the division of labor will break down. You can't have that.
Yep. Rob?
I kind of agree with both of you, Chris. I think it is kind of like the mafia. There are Eastern, Western, different institutions that are vying for power. Certainly China's wanting to rise now, and looks like they have the economy to do it. They've just been going gangbusters in a lot of ways. Of course, they have their own issues with their own banking system and some of their state-owned entities. But it is like different, mafioso families fighting each other for dominance. But the one thing that they agree on is that they need to control the markets and control the masses. And I do think the one thing that will end up breaking that, as Rafi said, is going to be shortages in food supplies, and where people can't feed their children. Because if you're a parent and you can't feed your child, you're going to do what you have to do. There's nothing that's going to stop you. And certainly we've seen that in some less fortunate countries, including one my wife came from in Cambodia, where the communists tried to basically subject them, and the people eventually, with the help of the Americans, of course, they eventually fought back. So I do think that we're in for a little bit harder times. And so beyond the gold and silver, you want to look for food security as well. That's a really good point by Rafi. But the whole world's not going to be able to do this. And so I think when it's going to go way beyond what we saw in the States. It's not going to be political. It's going to be, people's ability to feed themselves and take care of their families when they're going to put pressure on the people at the top, and when that system is probably going to break.
Yeah, and Rob, one of the things that's, it was a great answer, although even better than that, I know people often, it's easy to get overwhelmed by the things that are going on. Yet, fortunately enough, you've put together Solutions 2021. So for anyone who's hearing this and saying, all right, great, I get it, money printing, this and that, but what can we actually do about it? Could you just let folks know what you're doing on Thursday?
So on Thursday, we're going to be holding our second virtual conference. The first one we held was last August. This one's going to be a single day. It is free registration for anybody. You just go to this website. It's on hoppin.com/events/solution-2021. The link is on my YouTube channel for anybody that needs it. We'll be talking through with a lot of experts, including you, Chris, on what to do when the dollar dies. That'll be my session with you. We'll be talking to Fernando Aguirre, who is a survivor of the Argentinian currency crisis. We'll be talking to a couple of different precious metals dealers. We'll be talking to Daisy Luther, who runs the gigantic website, The Organic Prepper, about other types of preparations like food, like Rafi talked about, and other ways to secure yourself in the coming chaos. And then we're going to have, as Chris is highlighting here, probably his favorite part, the after party, where for 2 hours, we're just going to sit and talk. So if you want to come express yourself, ask questions, tell people your story, come do that at the after party. I hear that Chris is going to be playing to Spring Cheese at the after party and going to be giving a concert. So look forward to that.
Not know that was on the schedule, but we'll see how all that shakes out. And Rafi, so people can be prepared. I know Rob has one of the smarter conferences around, but one of the ways you could be up to date is going to the Endgame Investor. And if you could let folks know what they get there.
I do a daily market commentary with an extra oomph on the weekends, weekend review. I review COMEX numbers. I review, issues of backwardation and contango. We go through the technicals and we go through the fundamentals. And I also very closely follow the bond market. This was my last letter that I sent to subscribers, so you get a little idea of what I write. And so I have some good emphasis on the actual primary markets in U.S. Treasuries and how much has to be sold per auction now that the federal deficit is like $5.3 trillion. And we go through the math. Like-minded people, if you're on lockdown or you can't leave your house, it's just good to talk to people with common sense, which is why I'm so glad to speak with you, Chris, and with Rob. And, it's not easy on lockdown, and common sense might be the only more commodity that's rarer than gold these days in so many ways. It's good to talk to people like you, and join us join my newsletter if you want to see what I'm writing for a 2-week free trial, no charge, and see what I'm doing.
Yeah, and I'm glad I just saw this because we talked with Andrew McGuire the other day about COMEX options expiration, which is today. And I'd love to discuss this further. We're actually opening an options club here at Arcadia, so it'll be great to maybe we can get you involved there, because I think that's one of the times where there are some clues of what might happen, and perhaps we'll dig into that in a future episode of the show. So thank you guys again for being here. Again, the links to both of those in the description field right below. Go there, click on it, get the Endgame Investor, read that, and then come join us at the conference on Thursday. Rafi, Rob, thank you so much for being here, and it'll be fun to follow how this plays out throughout the year.
Thank you, Chris.
Thank you, guys.